Recently, I have sparked some interest in real estate and would like to further my understanding of property value holdings. Therefore, I've decided to perform a detailed financial valuation analysis of your property. So, sheet one here contains underwriting information related to a given property. So, I have units, rent, vacancy, operating expense ratio, the growth rate, purchase price, exit cap rate, sales cost, unlevered discount rate, and the holding period of the property, which is 5 years. So my goal is to determine the effective gross income, total expenses, net operating income, cash flows, net present value, IRR, in order to determine whether or not an investment in the property will be beneficial if I hold the property for 5 years. I'm going to give you a quick run through of my calculations. So I formatted here a pro forma income statement, since my goal is not to show you how to get these calculations, but rather show you how to create interesting visualizations to interpret the numbers on this page. I am just going to spend a few minutes talking about my calculations for context. Later, we will put these numbers into Power View and create some fun charts to observe trends and determine my real return, if any, by investing in this property. So the first thing I want to look at is the income. So first calculation I have here is the potential gross income, which you achieve by multiplying the number of units by the rent per month. That's 1,500 times 12 because it's for 1 year, and you get $5.4 million. Okay, then we're gonna subtract the vacancy, which is the vacancy percentage, 7%, times our potential gross income. We get this, and then for expected gross income, we're just effective gross income, we're just going to subtract these two here. We get this. Obviously, you slide everything down, you get all of your numbers filled in. And since the holding period is 5 years, I have these calculations all the way up to 5 years. We also have the expenses here. So to calculate the expenses, I multiplied 40%, which is our OPEX, by our EGI. Okay, and then you just slide that down there for the 5 years. All right. Okay, our next calculation is net operating income, which is simply the effective gross income minus the total expenses. You'll drag it down for the 5 years, and we'll move on to cash flows. So we repeat the net operating income, and now we need to put in the sales proceeds so that we can subtract that from the 4th year of our holding, since we'll be selling the property. So in order to do that, we're just going to go over here to our sales price calculation that I did super quickly. Okay. Alright. Our net sales proceeds are $44 million, which is what I have here. And we're going to subtract to get, we're going to add these together to get the 47.6 million in cash flow for our 4th year. All right. Okay, so I discounted the cash flows over the 4 years. I found the present value by summing up these discount cash flows. We were given the purchase price of the property, and then I calculated NPV by subtracting the present value and the price. I did the long way without using the Excel function, but that was just to be able to see how the numbers worked. And then we're able to see here that our NPV is a positive number, so therefore I would buy this property. Just to have another form of analysis, I went ahead and found the IRR, and just by putting in the price, the original purchase price, as a negative, and then we have our cash flows and operating income, net sales proceeds, and then here I did use the IRR function of Excel. I just put the range of the values, which is basically B41 all the way to F41, and the IRR is 8.69%. Our discount rate that we see here, where is it, is 8%, and our IRR is 8.69%. So since the IRR is greater than the discount rate, I would therefore accept this investment. So now that I've gone through all the calculations, I'm going to start converting these expenses and operating income, cash flows into tables, because I'd really like to see how the number grows each year. So the first thing I want to look at is the income. So first calculation I have here is the potential gross income, which you achieve by multiplying the number of units by the rent per month. That's 1,500 times 12, because it's for 1 year, and you get $5.4 million. Okay, then we're gonna subtract the vacancy, which is the vacancy percentage, 7%, times our potential gross income. We get this, and then for expected gross income, or just effective gross income, we're just going to subtract these two here. We get this. Obviously you slide everything down, you get all of your numbers filled in, and since the holding period is 5 years, I have these calculations all the way up to 5 years. We also have the expenses here. So to calculate the expenses, I multiplied 40%, which is our OPEX, by our EGI. Okay, and then you just slide that down there for the 5 years. All right. Okay, so just to go back and show you, I created tables for expenses, net operating income, and cash flows for the 4 and 5 years. And I have it in, here we go, in Power View. So the first table I have here indicates the data for the expenses over the 4 or 5 years. So now I was just choosing the best visualization to really look at the trends of the expenses for each year. Okay, so I really like this chart here. I think it shows the gradual increase in expenses from year 1, which is in this turquoise color here, and then gradually increases all the way to year 5. And I chose them here from the visualizations. Okay, so to the right here you see my 3 tables. Table 2 is the operating expenses, the net operating income, and then the cash flows. We're able to see how the income sort of increases each year. Here we see the operating expenses also increase each year, and then here we see the cash flow from year 4 to be 47 million. Whereas the purchase price was 42,000. So there was a net increase of a little more than 8%. I think we said it was 8.69%, and therefore, just seeing these visualizations, it makes sense to invest in the property.